September 23, 1998, 8:45 in the morning. 14 of the most powerful bankers in America sat in a single room in Lower Manhattan. They had not come for a business meeting. They had not come to make money. They had come because the Federal Reserve called them and told them that if they did not act before noon, the entire global financial system could begin to unravel before the end of the week. One hedge fund, one firm with fewer than 200 employees, one group of men who thought they had mathematically eliminated the possibility of failure. They had not. By the time that morning was over, those 14 banks would agree to inject $3.6 billion into a company they knew was already dying, not to save the company, but to save themselves and everyone else on the planet from what would happen if they did not. This is the story of long-term capital management. This is the story of what happens when the smartest people in the world decide that they are smarter than the market itself. And this is the story of how two Nobel Prize winners helped build a machine that almost destroyed the global economy and then walked away. To understand what happened, you need to understand the man who built it. His name was John Meriwether. He grew up on the south side of Chicago, the son of an Irish Catholic family with very little money and very large ambitions. He was not the kind of man who made speeches. He was not the kind of man who appeared on magazine covers or gave interviews about his philosophy of life. He was quiet, controlled, and utterly ruthless in pursuit of one thing: the trade. By the 1980s, Meriwether had climbed to the top of Salomon Brothers, one of the most feared investment banks on Wall Street. He built and led the bond arbitrage desk, a group of mathematicians, economists, and traders who made enormous sums of money by finding tiny pricing gaps between bonds and betting that those gaps would eventually close. It worked for years. It worked brilliantly. His team produced hundreds of millions of dollars in profit and became legends inside the bank. But in 1991, everything fell apart. One of his traders, a man named Paul Moser, was caught submitting fraudulent bids in United States Treasury auctions. It was a federal crime. Meriwether had been told about it and had not reported it fast enough. He was fined and forced to resign from Salomon Brothers. For most men, that would have been the end. For John Meriwether, it was only the beginning. In 1994, Meriwether launched a new fund. He called it Long-Term Capital Management. And the team he assembled around it was unlike anything the financial world had ever seen. First, he brought in his old colleagues from Salomon, the mathematicians, the quants, the traders who had followed him out the door when he resigned. Then he recruited two men whose names would have stopped anyone on Wall Street cold. Robert Merton, professor at Harvard, one of the architects of the most important formula in modern finance. Myron Scholes, professor at Stanford, co-creator of the Black-Scholes model, the equation that defined how the entire world priced financial derivatives. In 1997, just 1 year before long-term capital management collapsed, both men won the Nobel Prize in economics. They won it for the very work that powered long-term capital management. Think about what this looked like from the outside. You have a hedge fund run by the man who built the most successful bond trading operation in Wall Street history. You have two Nobel Prize winners on the board of directors. You have dozens of the most credentialed quantitative analysts on Earth running the models. The minimum investment to get in was $10 million, and investors were begging to hand it over. When the fund opened its doors in 1994, it raised $1.25 billion in capital, the largest hedge fund launch in history at that time. The logic was simple and it was seductive. These men had mathematically solved risk. They had built models that could predict with enormous precision how markets would behave over time. They genuinely believed, that they had found a way to harvest money from the market the way a farmer harvests grain, systematically, reliably, and without real danger. For the first 3 years, they appeared to be right. In their first full year of operation, long-term capital management returned 21% to investors after fees. In the second year, 43%. In the third year, 41%. These were not just good numbers, these were extraordinary numbers. The kind of numbers that made every pension fund manager, every university endowment officer, every sovereign wealth fund director in the world take notice. But something was happening underneath those returns that almost nobody understood. The trades that Meriwether and his team were making were not high-margin bets, they were tiny bets. Fractions of a percentage point, the kind of tiny price difference between two similar bonds that would eventually, almost certainly, close over time. The problem was that to make serious money from a fraction of a percentage point, you need to make that bet at enormous scale. You need leverage. Long-term capital management used leverage in a way that shocked even experienced Wall Street professionals when they later learned the full picture. By 1997, the fund had approximately $5 billion in actual investor capital, but it was controlling positions worth $125 billion. That is a leverage ratio of 25 to 1. For every $1 the fund actually owned, it had borrowed and deployed 24 more. And then, in what one analyst later called perhaps the single most reckless financial decision in the history of the fund, Meriwether and his partners decided the fund had grown too large. They returned $2.7 billion to outside investors, to their own outside investors. They sent the money back. But here is what they did not do. They did not reduce the size of their position. They kept all $125 billion in trades in place, while cutting the equity cushion underneath it from $5 billion to roughly $2.3 billion. The leverage ratio did not go down, it went up to 28 to 1. They had concentrated the risk at the exact moment when they should have been pulling back. August 17, 1998, a date that most Americans do not remember, a date that the men at long-term capital management would never forget. On that day, the Russian government made an announcement that sent shockwaves through every financial market on Earth. Russia was defaulting on its domestic government bonds. It was also devaluing the ruble. Now, long-term capital management did not have massive direct exposure to Russian bonds. Their positions were hedged, or so they believed. If Russia defaulted and its currency collapsed, they had bets in place that should have offset the losses. But something happened that their models had never predicted. Not because the models were wrong about Russia, but because the models could not account for what Russia would trigger in the psychology of every investor on the planet simultaneously. When Russia defaulted, a wave of panic swept through global markets unlike anything seen since the 1920s. Investors everywhere, institutional investors, banks, governments, did the same thing at the same time. They fled from anything that felt risky, emerging market bonds, anything that was not a United States government treasury bond. This created what market professionals call a flight to quality, and it was catastrophic for long-term capital management. Because every single trade they had was built on one assumption, that two similar assets would eventually converge in price. In a panic, they do not converge, they diverge. Every investor on Earth was selling exactly what long-term capital management owned, and buying exactly what long-term capital management had bet against. In August of 1998 alone, the fund lost $1.85 billion. On August 21st, a single day, it lost $550 million. The model had said that losing that much in a single day was so unlikely that it would happen once in the history of the universe. It happened on a Tuesday. As the losses mounted, something else became terrifyingly clear. The fund could not simply sell its positions and exit. The positions were too large. If long-term capital management tried to sell any significant portion of its portfolio, the act of selling would itself crash the prices of the assets they were trying to sell. They were trapped. They sent a letter to their investors on September 2nd describing the August losses. They attempted to raise emergency capital. They called Warren Buffett, the legendary investor, and asked him to buy the fund. Buffett made an offer, $250 million for the portfolio and a complete takeover of management. It was an offer that would have wiped out the existing partners entirely. They declined. They also called George Soros. Soros passed. They called Goldman Sachs. Goldman Sachs was simultaneously putting together a competing offer while quietly gathering information about the fund's positions, information they could potentially use if the fund collapsed. Trust had evaporated completely. Meanwhile, the Federal Reserve was watching. The new president of the Federal Reserve Bank of New York, William McDonough, received a call from Meriwether on September 18th. Meriwether explained the situation. McDonough made a decision that would define his legacy and ignite a debate that continues to this day. He decided the Federal Reserve would act. Not to lend money, the Fed would not put taxpayer dollars into a private hedge fund, but to convene the room. On September 20th, Federal Reserve officials walked into long-term capital management's offices in Greenwich, Connecticut. They were accompanied by bankers from Goldman Sachs and J.P. Morgan. What they saw shocked them. Long-term capital management had executed swaps, complex derivative contracts with 36 different counterparties. Each counterparty knew its own exposure. None of them knew the total. The off-balance sheet leverage, the hidden derivatives. The interconnection, it was so vast and so complex that the officials standing in that office could barely calculate what a collapse would mean. But they understood the direction. If long-term capital management failed in an uncontrolled way, the forced selling of its positions would send shockwaves through every major bank on Earth. Banks that had lent money to the fund, banks that had trading positions with the fund, banks that had exposure to the same assets the fund was desperately trying to sell, they would all be hit simultaneously. It would not just be an American crisis, it would be global. September 23, 1998, the same morning we began with. McDonough gathered the leaders of 14 of the largest financial institutions in America into a conference room at the Federal Reserve Bank of New York. Merrill Lynch, Goldman Sachs, J.P. Morgan, Morgan Stanley, Deutsche Bank, Barclays, UBS, Societe Generale, Lehman Brothers, Bear Stearns. The men in that room were not friends, they were fierce competitors. In any other circumstance, the collapse of long-term capital management would have been an opportunity, a chance to pick up assets cheaply while a rival stumbled. But McDonough explained the situation to them plainly. If this fund collapses today in an uncontrolled way, the losses will spread to all of you. You will not be spectators watching a competitor fail, you will be casualties alongside them. By end of that day, all 14 institutions agreed to contribute a combined $3.6 billion to recapitalize the fund. In exchange, they received 90% ownership of long-term capital management. The existing partners, Meriwether, Merton, Scholes, and the others, saw their equity collapse to almost nothing. The partners had had more than $1 billion in personal wealth tied up in the fund. Most of it was gone, but they were not prosecuted. They were not fined. They were not banned from the financial industry. John Meriwether went on to start 2 more hedge funds. Myron Scholes and Robert Merton returned to their academic careers. The Nobel Committee did not ask for the prize back. The bailout worked in the narrow sense. Long-term capital management was wound down gradually over the following 18 months. The 14 banks that rescued it eventually recovered most of their money. The global financial system did not immediately collapse, but the cause of the crisis was never addressed. The extreme leverage, the opacity of derivatives markets, the assumption that mathematical models could capture human behavior in a panic. The belief that smart enough people could eliminate risk rather than simply move it somewhere else. None of it was fixed. Later wrote that the men of long-term capital management had made absolutely no allowance for the possibility that they simply did not understand markets, that their methods could be wrong. That is the most dangerous kind of confidence, not the confidence of someone who knows they might be wrong. The confidence of someone who has convinced themselves that being wrong is not mathematically possible. When the Federal Reserve intervened in September of 1998, it established a precedent that certain financial institutions were too interconnected to be allowed to fail in an uncontrolled way. That precedent would be tested again, far more dramatically, 10 years later. In 2008, when mortgages packaged into securities, traded with enormous leverage, and distributed across the global financial system began to collapse, the world discovered that the lessons of long-term capital management had not been learned. They had merely been forgotten. 2 Nobel Prize winners, 1 genius trader, $125 billion in exposure, 4 months to lose everything. And a world that came closer to financial collapse than most people will ever know. The men who built long-term capital management were not fraudsters, they were not criminals. They were something more dangerous. They were brilliant people who believed, in the face of every warning, every signal, every crack appearing in their model, that they were right. And the market was wrong. The market is never wrong. It is patient. It waits. And eventually, no matter how sophisticated the formula, no matter how many Nobel Prizes hang on the wall, it collects.